What's up, you guys? This is Brandon from Vegas. Welcome back to Won't You Be My Neighbor podcast. We're here today with my lender, Ryan Olson, for everybody's favorite topic, the most popular class we teach, how to build a real estate empire with equity, becoming a real estate investor / mogul without using much of your own money. I brought Ryan in here today because this class requires a lender, someone who can tell you guys, hey, this is how you do it. This is where the money goes. This is how you refinance, all right? Let's jump right into it. I know you guys have been watching for a while, so I don't want to delay you any further. We appreciate you guys. We're keeping the education free here. All right, we're going to start here. What is equity? What is equity? Equity is the difference between what your asset is worth versus what you owe and paid for. Ryan, can you tell people a little bit about what they can do with their equity?
Yeah, so I think kind of the focus of what we want to educate people on in this podcast is, how you can use your equity to potentially buy other properties, or refinance, make your payment cheaper. So when you buy your first home, depending on what you put down, and then what you buy the home for, the difference between the loan amount and the purchase price of the home is the amount of equity you have. So if you buy a home for $400,000 and you put $100,000 down, then you have $100,000 equity. Obviously, you don't have to put $100,000 down. Sure, it's just an easy example. And then as time goes on, more than likely the value of the home is going to grow, and your loan balance is going to go down through just making payments. So that means your equity grows because the value of the home is higher and your loan amount is lower. So maybe you bought at $400,000, you have a $300,000 loan, and then over a year's span, maybe you paid it down to $290,000, and now the value's gone up to $425,000. So your equity's grown to $135,000.
You could not have used better numbers because check this out, guys. On the screen, we are literally showing you what Ryan looked like. Your house cost $300,000. You put down $10,000. You owe $290,000. Pretty easy, right? Over the next 3 years, you pay off $10,000 of the principal. Remember, guys, most of your mortgage payment is the interest. So when you're putting a little bit extra towards your mortgage, remember to tell them you want to put it towards the principal, okay? So over the next 3 years, you pay off $10,000 of the principal, which means you now owe $280,000. The $10,000 you put down originally, the $10,000 you've paid off over 3 years. So now you owe $280,000. Well, guess what? You go and call Ryan and you say, hey, Ryan, I need an appraisal on my house. Can you order an appraisal? Ryan will say, hell yeah, we can order an appraisal. How long does that usually take to get an appraisal?
Like a week or two at most.
About a week or two. And what's it cost? Like $350?
Yeah, and you usually have a goal in mind, for financing before you just get an appraisal. You can get an appraisal just randomly if you want to know how much it's worth. But yeah, usually like a week or two during a loan process.
Cool. So about a week or two to get your appraisal. Your appraisal comes back and it says your house that you bought for $300,000 is worth $350,000. Well, guess what? You owe $280,000. And you have something worth $350,000. Guess what that means, boys and girls? Your equity is $70,000. It's the difference between what you owe and what the house is worth. Well, what can you do with that equity? That is what I'm here to teach you guys today. You are going to use this equity to start your real estate investment career. This is how you are going to become a real estate mogul. That's right. With $10,000 down, we are going to show you guys how to get this going. So on the screen, you guys see it behind me. You have $70,000 in equity. You need 20% of $300,000, which is what you bought the house for, to make it an investment property. 20% of $300,000 is what? $60,000. So if you have $70,000 in equity, guess what? You have your 20%, don't you?
Mm-hmm.
Don't you? Ryan, can you please tell people so they understand, is there any difference between putting 20% down in cash or 20% of equity?
I'm not sure what you mean by that.
So if someone walks into your office and they say, Ryan, my house has 20% equity. I've got $100,000 in equity. I want to refinance into a conventional investment property.
I see what you mean.
Is there any difference than if they walked in there and said, hey, Ryan, I have 20% cash. I'm going to buy an investment property.
Yeah, so I'll give a little information on that too. So what Brandon's getting at is if you put 20% down on a home when you first buy it, there's some advantages to that. You don't have to pay what's called monthly mortgage insurance. A lot of the times you'll get a better rate. So a lot of the times in the beginning, people don't have 20% to put down. Most people don't. So, you put the 3% down, 5% down, whatever it is initially, and then maybe in a couple years when you've grown your equity, as the way we've explained, and you have that 20% equity, now you could potentially, refinance the loan if as long as rates are better or the same or whatever. You could potentially remove your mortgage insurance, potentially lower your rate, and then you have that 20% equity. So when you go to do that new loan on the refinance, you get potentially the same benefits you would have as if you were buying a home with 20% down.
There you go. So tell me, guys, would you rather take $60,000 out of your own pocket to buy a home, to get into an investment property, or would you rather let the house pay $60,000 by itself? I think most of you get where I'm coming from. A lot of folks don't have $60,000 to put down. And honestly, why would you put down $60,000 on a $300,000 property? That doesn't even make sense. That's a lot of money to invest into a basic starter home.
Right. Yeah. And there might be certain scenarios if you have a whole lot of cash, maybe it could make sense. But a lot of the advice over the last several decades in the past has been you need to wait till you have 20% to put down. It's kind of a misconception.
Yep.
But what we're just talking about here is you're building equity in the home. So it may take you 2 years, 3 years to get to that 20% down payment. But if you would have just put the 3% down, 5% down, whatever, and bought the home earlier, you would have gained all that equity while you were waiting for that 20% down. So you could potentially miss out on a larger asset by waiting to save that 20% down.
Yep. You guys, we're going to take all questions on the YouTube Live. So I see you guys on TikTok. On TikTok, if you guys have questions, make sure you guys hop over to the YouTube Live. We're going to be answering questions in just a few minutes. Please save your questions for the YouTube Live. We're streaming live there as well, okay? So once you have 20% of your house's equity, you refinance or alter your loan into a conventional investment loan. This turns your house into an asset. What that means is you can now rent your house out full time. Remember, you guys, when you start off with an FHA loan or a 3% down loan, you have to stay in the house for 1 year?
Typically, when you buy a home as a primary residence and you utilize those advantages of putting 3 to 5% down, 3.5% down, the agreement has to be that you plan to live in the home for at least a year. So things could change, but that has to be your plan for the home.
Your plan. So once you have 20% down, though, right? You're free to. It's 20% down. It's officially.
Well, sorry, real quick on that too. Let's say you bought a home, you lived there in a year, and then you wanted to upgrade or whatever, and your family grew or whatever, and you want to turn that home into a rental property and buy a new home. You actually don't even need to have 20% equity in that.
You see that?
You just wouldn't necessarily be able to remove your mortgage insurance, or there's certain things that come along with that. But you could live in that home for a year. Maybe you only gained get to 10% equity, and you want to go upgrade your home. Well, you could still turn that home into a rental property, and then you could put 5% down on the next home.
Sure. The reason we tell you guys to still go with the 20% is to eliminate that mortgage insurance. If you have an FHA loan, you're paying a mortgage insurance premium. Mm-hmm. If you're on a conventional, it's going to be called PMI, private mortgage insurance, right? At 20% down, you can eliminate that. The reason this is important to do before renting out your house is it lowers your mortgage. Well, the lower your mortgage is, the more money you get to make when you rent out your house. Also, right, I know we can't do any exact estimates because you're not in front of your computer, but what's the difference in a mortgage between 3% down and 20% down? Would you say it's about $500 a month?
Well, yeah, it depends on the loan amount and all that. And
Sure.
I like to think I'm good at math, but on the spot here, I don't know.
I cheated. I have a mortgage calculator. I cheated.
Sure, yeah. Yeah, and it obviously depends on the price of the home and all that. But
sure.
Yeah, well, what numbers do you have here?
So I cheated. I cheated. We used a mortgage calculator. You guys can all pull this up at any time. You go to Google and you type in mortgagecalculator.org. It's not exact, but we do this so you guys can get a rough estimate of some of the numbers, right? So if we go to your $400,000 home and we put in 3% down, we put in 3% down and we go calculate your payment, right?
Of course, it obviously depends on your credit score, your scenario,
sure.
loan program. All
Sure,
that. But this is
all
just
of
a
that.
general idea.
Just a general estimate, right? If we put 3% down, your monthly payments are about $29.50. $29.50. Now, if we do the same thing and we do 20% down, okay? We do the same thing and we do 20% down. We go from $29.50 to $23.50. Do you guys understand? You lose $600 from your mortgage payment, but your renter is still paying $29.50. You understand? Your renter's paying $3,000, but when you refinance and you're paying $23.50, your renter is now paying the difference. So now you're making what's called, let me see if I have it on the board. If I'm good at this, it should be popping up. Now you are making cash flow. I think it should be number 3. Cash flow, baby, right? If your mortgage payments are $2,300 and your renter is paying $2,900, you're making $600 a month. Now, a lot of people waste this opportunity, Ryan. A lot of people waste this opportunity. They take that money and they do what? Spend it on dumb shit, get a nicer car, shit that's not going to make them more money. What is the best way, or not the best way, okay? Because we can't give everybody financial advice, but what are some of the things they can do now that they have an investment property and they have an additional $500 to $600 in cash flow?
Yeah, I mean, you could, in some cases, you can use the rental property income as income to help you qualify for the next home. In some cases, you can't, depending on how long you rented it out and all that.
Sure.
But yeah, I mean, I actually look back at some of the homes I've owned, and I wish I would have kept them as rental properties. And I sit back and look at the amount of equity that I would have and the cash flow that I would have. And I regret selling them.
Yeah. When you realize how much money is now in Las Vegas rentals, right? Like the rental market went crazy. We went here from like $1,500 for the average rental to $2,100.
And another thing worth noting too on the way that works is, interest rates, we don't know what will happen for sure, but I think it's safe to assume that they probably will come down at some point.
Yeah.
Excuse me. So if you buy a house now at current rates, in almost every case, it's a fixed rate, meaning you never have to worry about that rate going up. But when refinance opportunities come along and you have the ability to lower your rate, you could potentially refinance. So, over time, you could potentially decrease the mortgage payment on each of your rental properties,
100%.
which is going to increase your cash flow.
That's
as well.
a huge thing for you guys to hear. If you have a rental property at 5% interest rate and the interest rate dips to 4.5, 4.2%, you can just refinance your rate and lower it. Now
you
you're
have to
paying,
qualify, of course. But
this is a huge reason why a mortgage is better than rent. You can keep adjusting your mortgage to lower your payments while your rent is probably going to keep going up. Someone said the interest rate's probably not going to go down. I got good news for the people who aren't cynical, and I got bad news for those of you who are cynical. New builds are offering low interest rates because they kind of see the market from a macro perspective. And if the reason that they're comfortable offering these adjusted interest rates is because they foresee the interest rate coming down. So if you think you're smarter than people who make billions of dollars doing this for a living, I got bad news for you.
And I always say, I always kind of hedge myself and say nobody knows for sure what's going to happen with rates.
Sure.
But if you're saying that rates are most likely not going to come down, please share the data that you're seeing to
please share the data that
back that up.
Yes. How do you have more information than people who get paid billions of dollars to do this for a living, right? Like you're just the smartest man on earth. So what I want to tell you guys, and this is something, it's crazy how few people know this. You can reuse your FHA loan or your what we call primary residence loan. So a primary residence loan is what? FHA loan, VA loan, and then conventional, anything under what, 20%?
Mm-hmm. Yeah, I mean, you could buy a primary residence with 20% down, but when you're buying it as a primary residence, meaning you're planning to live in the home for at least a year, you're able to buy a home using an FHA loan with 3.5% down. Conventional, if you're a first-time buyer, you could buy with 3% down. If you've owned a home in the last 3 years, it's 5% down. And you'd have to see you'd have to get with a good lender and determine which of those programs is best for you.
Sure.
Sometimes you'll get your uncle that says, "Oh, you've got to use an FHA loan if you're buying," and really that doesn't make any sense at all without knowing the exact scenario.
Your Uncle Joe is giving you guys the worst advice. You got to put 20% down. FHA loans are only for first-time buyers. Like your Uncle Joe is giving you guys the shitty. the worst information
And sometimes
possible.
these options are slightly evolving too. So 20 years ago, the options were completely different than now.
Sure. Sure. You guys are no longer walking off the farm down to the bank with your cash in hand, begging the bank to, not steal your house. Okay. So what I want to tell you guys is this. When you first got your home, the only money you had was the job you were working, right? So you were trying to pay off your mortgage, pay off that 20% with just your job. Well, when you go to reuse another FHA loan or another primary loan, now you have the same job you're working, but you also have the money, the cash flow from your investment property to help pay off the other mortgage. So that $500-$600 that you're making from your first investment property, you can take that money and pay it towards the principal of the next house. So every month you're paying off $500 towards the principal, $500 towards the principal, $500 towards the principal, or you're saving that money up to get another 20%. Right?
Or just if you don't mind moving every year, you could keep buying it 5% down every year as a primary residence.
Or Ryan, can you repeat that for the people on TikTok? They need to hear what you just said.
Yeah, so you have to live in it if you're buying as a primary residence. One of the benefits of that is low down payment. So you just have to plan to live in that for a year. So if you live in it for a year and you decide you want to go buy another home and turn that home into a rental home, you can go buy the next home with 5% down. Now it's not as simple as just go do it. You still have to make sure you have good credit and decent income and, qualify for each next scenario. But it's definitely an option for people.
Yep. You said some information that's so good. I'm literally going to put it on the board so people can see it. If you don't mind moving every year, you can rent out the house after 1 year, put down another 5% and keep chugging along. Okay. The way I'm doing it, I'm trying to tell you guys to get 20% equity because my goal is to teach you guys how to do it with the least cash out of your own pocket, right? But if you're someone who doesn't mind moving every year, you can rent out the house after 1 year, put down another 5% and just keep chugging along. Serious. Every year, new house, rent it out, live in a new one. 1 year later, rent it out, get a new house, keep chugging along. Why are you doing this? Why are you doing this? Why do you keep this process going of getting a rental property, using the cash flow to get another rental property? Why? You guys, that first house that you rented out is still making you equity. Just because it's a rental property doesn't mean you stop gaining equity on it. No. Now you're getting the rent money and you're also making equity. So now you'll have two houses making you equity, one of them generating rent. So what do? Now you got two houses making you equity, one of them making you rent. Well, what if I told you can repeat the process again? You can repeat the process again with 20% down, equity or cash to refinance this house into another investment. Ryan, can anybody stop you from doing this multiple times?
No, I mean, if the opportunity to refinance, you have the 20% equity on the home that you bought as a primary with 5% down. Now you have 20% equity, and rates, as long as rates didn't, go up way higher than what you bought it at.
Sure.
You could refinance, potentially get into a better loan scenario. And you could keep doing that. I mean, you have to qualify. You have to have income. You have to have good credit and all that. So you have to make sure you're still earning income and you've maintained your credit. But other than that, and as long as we don't see a weird period where rates go way up or something like that, then probably is a good scenario where you could refinance.
Sure. What you guys need to remember is, yes, you have a mortgage, but there's someone living in your house paying the mortgage for you. It's not a debt. I mean, it's still a debt against you, but someone else is paying that debt. Someone else is paying that debt for you.
Yeah. One other good thing worth noting is if you use a conventional loan as opposed to FHA loan when you buy the primary home, once you get to the 20% equity, you potentially don't even have to refinance to remove the monthly mortgage insurance, just a chunk of your payment that you pay whenever you pay less than 20% down. So sometimes you get to that 20% equity mark. Sometimes it has to be a little bit more, depending on your particular loan. And you could actually just have the bank remove that. Maybe you have to get the home appraised, but you may not even have to refinance. So especially like when rates were in the 2s and 3s, people were buying a primary home and they're getting 3% 2 years ago. and now they have 20% equity, there would be no need for them to refinance unless they were in an
100%.
FHA loan.
That is one of the advantages that conventional loans have over FHA loans. You don't need to refinance to eliminate anything. Once you get that 20% equity, you're good. Head to your lender. Just tell them, hey, I got my 20%. Let's go. This is now a conventional investment property. All right. So you guys keep going on this path. Now you have two homes. You have two homes making you cash flow and gaining equity. Do you guys understand what that means? Like, I really, people think that becoming a real estate investor or having real estate become like a, not a side hustle, but another passive income for them. They think it's this crazy, outlandish, oh, I got to have $1 million to do it. If you have two investment properties making you cash flow and generating equity, do people understand how much value that is? If one of the houses booms and let's say, oh, another real estate boom happens and now that house is worth $150,000 more, do people know what they can do with $150,000 worth of equity?
Right. Yeah. And I'll kind of note on that. Like I said earlier, like one thing I wish is I would have never sold any homes that I've bought. I wish I would have just kept them as rentals. And, I've been doing mortgage loans for 11 years now. And, you see like middle-class, hardworking people, they don't make $1 million a year. They make a regular salary. And the smart ones who save their money, and focus on being able to buy those additional properties, they do have that cash flow. Some of these people have multiple properties with cash flow. Some of them paid off. And this is how you can just make a regular salary. And it's not as simple as like you do this and everything works out perfect. There are certain variables that can come into play. But this is a way someone who just, makes a decent living can really build a lot of wealth doing this over time.
There's a lot of people watching right now, honestly. There's a lot of people watching right now who already have homes. And they have equity just sitting in their homes, and they're not utilizing it. They're not using it. They don't even realize that they don't need cash. They could just take the equity from their home and use that as the down payment for their next home. They could already have an investment property with the equity they've built in their first home.
Right. Yeah.
That's what we're trying to teach you guys. Do not it's like having money sitting in a bank account. Okay, your money sits in a bank account and it feels safe. It feels secure. But it's just sitting there. It's not making any money for you. Right. Inflation is making your money worth less money every day. You need to find a way to make your money make money for you. You need to find a way to make your equity make more equity for you. It's the same concept, right? What I want to finish on before we get to questions is you guys have to see this. Once you have two rental properties making cash flow and generating equity, you'll never need to use your own money again. All you need to do is wait for the equity and the cash flow to build up enough that you have enough for the next down payment on the next home. You can stop using money from your own pocket. All you're going to be doing is using your rental money and your equity from your two investment properties to buy a new property.
Yeah, and to provide clarification on that too, what you're talking about is one thing we haven't gotten into specifically is when you have a certain amount of equity, in a lot of cases, you're allowed to withdraw some of that equity out of the home through the refinance.
Yep.
So if you have 30% equity in the home, sometimes you could withdraw that 10 and you have to leave the 20, and then you can basically get that 10 paid to you. Sure. And then you can use that money for a down payment.
100%.
Of course, that's increasing your loan amount, so that affects the cash flow a little bit, but a lot of people do that because, like Brandon said, you don't have to save or come out of pocket with the next down payment.
100%. The goal, like you guys, if you have enough money and you don't want to use your equity, you can use cash for it, right? But my goal is to show you guys how to keep as much cash in your pocket as possible. If I have 3 investment properties, what's the odds that one of them has pretty good equity in it, right? Because you bought one of them this year, and then you bought the next one 2 years after that. Then you bought the next one 1 year after that, right? So at different time periods, they're gaining equity at different rates.
Sure.
One of them booms, right? Let's say you bought a house in Summerlin, and oh crap, it boomed. Or you bought a house in Inspirata, a new build, and now Inspirata's boomed, right? There's a chance there's equity in that house. There might be also equity in the second house. Yeah. Now you have 2-3 houses to pull equity from instead of just the one that you originally started with.
Right. And, honestly, 2020, 2021, it was kind of like an anomaly. People who bought, people owned homes during that time were very lucky to see their values grow substantially. So it doesn't need to grow at that rapid rate, 20% a year or whatever. I mean, I think historically home values grow over 4 to 5% a year. So, and that's a healthy thing.
Yeah. You guys need to hear that. I'm going to repeat it again. Everybody needs to hear this. You can research this. The average American home in what they call a major city. A major city, population with 500,000 or more, gains 5% equity on average over a 5-year period. This does not mean that your house always gains 5% equity. What it means is over a 5-year period, the average American home will gain 5% per year. This is on average. This isn't even factoring in that places like San Francisco, it might boom 10%.
And this is accounting for, when we saw the crash in 2008, or, like people, let's say someone bought in 2020, their value went up a whole lot. Maybe it went this year, maybe honestly went down a little bit, or 2020 was a rough year, a relatively rough year. But if you went up 20% in 1 year and then it went down a little bit, you're still up, right? Yep. So one thing that a lot of people in our generation need to understand is this is not a get-rich-quick scheme.
It is not a get-rich-quick scheme.
And things go up and down, but generally it's that 4 to 5% range that over time it kind of evens out.
Houses are a safe investment. Now, you guys, there's nothing risk-free in the world. This is what I tell people all the time in my class.
Right.
There's nothing risk-free, right? There's a risk with anything involving money making, but houses are a very low-risk investment for one simple reason. Name a time period where people don't want to live inside.
Right. Yeah.
I'll wait. Name a period of time where you don't want to live inside. Even if you live on the beaches of California, you probably want at least a hut or a shack or something, right? Like when it rains, there won't be a time period where people don't live in houses. So owning houses is never going to be a bad investment over time because, much like Warren Buffett said, you're investing in something people need. It's a commodity. All right, you guys, thank you for letting us go through this. I'm going to put Ryan's information on the board. Ryan, can you tell the folks how to reach you and which states you work? Ryan Olson, All Western Mortgage. And what's the best number to reach you at?
So we'll start, with my number, 702-747-7184.
That's 702-747-7184. And what's the best email?
R. Olson.
Oh, crap. Hold up. We're low power on TikTok. All right. When we go low power on TikTok, it stops the stream.
Oh, does it?
Yeah. Okay. It stops the stream. So we have to let the stream. Yeah, there we go. Okay, we're back on. So R. Olson
at allwestern.com.
Allwestern.com. All right. And what states do you work in?
So Nevada, California, Oregon, Washington, Arizona, Texas, Colorado, and Utah.
Damn.
And if you want info and you're not in any one of those states, I can't originate a loan for you. But my company, All Western Mortgage, we're licensed in we're growing more and more every year. So we have, I think, more than half of the country covered. So I can always refer you to someone in my company as well.
Perfect. You guys, that's Ryan Olson with All Western Mortgage. When you guys rewatch if you're on TikTok right now, the camera is facing me, so you guys can't see him right now. But when you rewatch the YouTube video, you will be able to see him. That's Ryan Olson at All Western Mortgage, 702-747-7184, or Ryan Olson or R. Olson at allwesternmortgage.com.
Oh, I'm getting blown up. No, I'm just
he works Nevada, California, Oregon, Washington, Arizona, Texas, Colorado, Utah. And if you're not in those states, just reach out to him and he will connect you guys with a lender there. All right.
And these days, mortgage is everything electronic, so can just as easily help you in any one of those states.
All right. You guys, give me 1 second. I've got to see how far my showing is. Give me 1 second. I got to see how far my showing is from this so I know how much time. Everybody who's watching on TikTok, head over to the YouTube live, BrandonFromVegas YouTube, or just go to my bio on TikTok or Instagram, and you'll be able to connect to the YouTube directly. We are live streaming right now. I'm going to answer your questions. Well, to be fair, Ryan's going to answer your questions. Most of your guys' questions are going to be on lending. So head over to YouTube Live and ask your questions. Ryan will answer them as I sit here and figure out how much time I have to get to 900 Las Vegas Boulevard. 900 Las Vegas. Which high rises are those? 900 Las Vegas Boulevard?
What was the question?
We're going to see what people's questions are.
Oh.
You guys.
Oh, you got to go there next.
Yeah. For those of you who have questions on TikTok.
Got to drive the traffic over.
Yeah, people who have been asking questions on TikTok, we tell them to ask the questions over on YouTube Live. So you guys head over to YouTube Live. Ryan's going to be answering your questions as I figure out how far away the Soho lofts are.
I told my client yesterday, everything's 20 minutes in Vegas.
Basically nowadays.
Liar.
Yeah.
That's a lot, especially tonight, and
Generally.
tomorrow, and
Damn.
Sunday. Don't take the 15.
The 15, yeah.
It's shut down, isn't it? Oh,
Yeah.
shoot. All right.
It's tonight though.
Oh, I had time. Okay,
Yeah.
guys, I'm telling you right now, we're not going to have time for questions. My apologies. It's 20 minutes away. If I'm late, this guy's going to throw a fit, so I cannot be late. If you guys have any questions, please save them. I'm going to have Ryan back next week to answer your guys' questions, okay? Ryan is going to be back next week to answer all of your guys' lending questions. So if you guys want to reach him before then, remember, it's Ryan Olson, All Western Mortgage, 702-747-7184. His email is rolson@allwestern.com. He works Nevada, California, Oregon, Washington, Arizona, Texas, Colorado, Utah, pretty much the whole West Coast. And if you're in any other state, he can connect you guys with a lender. All right. Thank you guys for your time today. I know we weren't here at our usual 10 o'clock time. Thank you, Ryan Olson, for coming in. Thank you, our producer, Austin. You guys, check out Bizarre Junkies, the TikTok, the YouTube podcast. He goes all kind of crazy stuff from guys who clean up crime scenes with dead bodies to if Yetis really exist. It's a cool podcast. Make sure you guys check that out. And we will see you guys next Friday at 10 a.m. Pacific, to be specific. I'm your host, the Black Mr. Rogers, Brandon from Vegas. Howdy, Won't You Be My Neighbor podcast. We're going to blow this thing up. Thank you guys for your support. See you next week.